Hello, welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi. We're going to talk today on a very timely issue, unfortunately. Markets are extremely downside volatile. I don't just say volatile because volatility can go both up and down, right? And nobody really has a problem with upside volatility. It's when it goes down. So what I want to do is I want to address what I think is kind of going on right now with with all the red ink out there. So the title of today was really, does explosive growth in a company, a specific stock, indicate that this time is any different than all the other times in the past? And so again, this is really very timely because it's dealing with a lot of huge negative returns on individual stocks, especially in the tech sector today, as of the recording, which is March 9th or so. I think I lose track of my days. So what we're going to do is we're going to single out, at least initially, NVIDIA. No reason. I don't have any specific, beef with them. I don't have any predictions for them one way or the other, but, history tends to rhyme. And as we've talked about before, I've been through the tech bubble burst before with the, internet revolution, and this just feels similar. So a case study on NVIDIA's recent stock growth and what we can learn from history. So NVIDIA Corporation has experienced remarkable growth, obviously, in recent years, positioning itself really as a leader in the technology sector. So as of today, March 9th, NVIDIA is roughly, the stock price is roughly $106 a share. By the way, February 26th, it was $131 a share. By the way, any individual stock price, either now or in the past, these are all coming from either Yahoo Finance or Morningstar. This is where I get my individual stock price data per specific days. So anyway, that $106 number, it's a substantial increase from earlier valuations. Like, for example, 5 years ago, the stock was priced at approximately $6.70, $70. So indicating a growth of over 1,800% during that period. And that trajectory mirrors some historical growth patterns of several other tech giants, mostly during my investing life, like, being in the career myself. So one example is Apple, Apple Inc. Apple's innovation in consumer electronics, we all know it's very well demonstrated, particularly the iPhone. And it led to a real surge in its stock price over the past 2 decades. Amazon, again, everyone's familiar with Amazon, its expansion from a bookstore to a global e-commerce and cloud computing company resulted in also exponential stock growth. And then we have Microsoft. Everyone knows about Microsoft, and really its cloud services and enterprise solutions really revitalized its growth because it struggled in that tech bubble burst of 2000 to 2002. And then more of I'll just say a newcomer to the party is Tesla. We all know Tesla, electronic vehicles, batteries, robot technology now. It's really propelled that stock to unprecedented heights. Of course, today, as of recording of this podcast, according to Yahoo Finance, Tesla stock is down 14% just today, and about 40% year to date. Now, these companies like NVIDIA and some of the others that I've talked about, they've demonstrated that continuous innovation, strategic market expansion, adaptability, these are key drivers of sustained corporate growth of really any stock. But does that explosive growth and seemingly insurmountable market capture mean that the stock in question is just always going to go up? I mean, everything goes up until it doesn't, which, again, I have been through. Probably some of you have as well, thinking back to 2000 to 2002. There are several companies in history that experienced explosive growth similar to NVIDIA, only to later suffer significant declines in value. So here are a few, and some of these you may have forgotten about. And then when I bring them up, you're going to go, oh, yeah, I do remember that. Number one, in no particular order, Cisco Systems. So this was like the dot-com boom and bust baby. Its growth phase was really the late 90s, that tech boom. And I got in the business in 98, so I remember Cisco as just a darling. And it was, believe it or not, this was the world's most valuable company, and all from internet infrastructure. Okay, so Cisco's stock hit $79 in March of 2000, so 25 years ago, quarter of a century ago, with a market cap exceeding $500 billion, about $500 billion, and then the collapse came. So after that dot-com crash of 2000 to 2002, that stock went down about 90%, hitting a low of $8 in 2002. Recovery? Hasn't had one. Cisco never regained its 2000 high, and it still trades well below that peak, even right now today as we're speaking. What about Intel? This is like market leader to struggler, right? So its growth phase was 1990s to early 2000s, also that techie boom time period it saw. We saw Intel dominate semiconductors, and that PC boom was really Intel's time to shine. Its stock was at an all-time high in 2000, and it was a dominant force in tech. The decline, really what happened with Intel, according to Yahoo Finance, it lost its technological lead in the 2020s to companies like NVIDIA and AMD, leading to a major loss in market value. And the recovery is a struggle story. Intel is attempting to regain their market share, but it is far from its peak. You're going to love the next one. Everybody in corporate America will know BlackBerry, smartphone pioneer that faded. So we all know the BlackBerry mobile craze dominated communication in the 2000s. My wife and I were just talking about BlackBerry, which is Research in Motion was that company's name. RIM was the stock ticker. And we were just talking about the other day how we loved that keyboard, the QWERTY keyboard, that physical keyboard. We love our iPhones, but there was something just different about typing on a BlackBerry, and its stock skyrocketed, and it became the world's go-to phone. In 2008, BlackBerry stock was at $147. The company was valued at $80 billion. What about its collapse? Well, we all know what happened. The rise of Apple and Android crushed BlackBerry, and by 2013, its stock had fallen to $6, from $147 to $6. The outcome is it never recovered. And right now, it's still a company, but it's in cybersecurity. It's not an iPhone. It's not something that you have in your pocket. I don't see anybody out there with BlackBerry. What about more old school companies? Maybe non-techie type companies. For example, GE. So GE was America's most valuable company at one point. Now, different phase, right? So GE was one of the dominant companies in the 1980s and 1990s under legendary CEO Jack Welch. Its peak was in 2000. GE's market cap was over $600 billion, over almost $500 billion. And it was considered really the bluest of blue chip stocks. It was it. Everybody owned GE. And then poor financial decisions and a decline in its industrial business led to a stock collapse, and it hit $6 in 2009. It's hard for me to even say that number. It's kind of like looking back at US Steel. These are stocks that you just would never ever expect to have something like that happen. And so that company restructured. It's rebounded, but it's not even close to its former glory. And now we'll go to a more recent one. So this is funny, just as the way timing is. Meta, which is Facebook. Huge drop, partial recovery. I literally just watched the movie, The Social Network last night, and I had to do some Googling on this because at the end of the movie, it said that, I forget when the movie was made, but it said that Mark Zuckerberg's shares were worth, I think what it said was $25 billion at the end of that movie, which was like a, oh my gosh moment. But as of not today, because I don't know what the stock is doing today, but as of say yesterday, he was worth well over $1 trillion. Just his shares were worth over $1 trillion. So Meta obviously is dominating social media. It reached a peak valuation of over $1 trillion earlier in 2020, and then the crash came. So Meta's stock lost 75%. I didn't know this. 75% of its value due to many things: weak ad revenue, metaverse struggles. If you remember how we were all going to live in the metaverse. And obviously just economic conditions. Now it's rebounded strongly in 2023 and 2024, but its long-term dominance, who knows? Yeah, we just don't know. And today, and so far this year, tech stocks are just getting crushed. So what are our lessons here? Where are we going with all this? NVIDIA's growth, its explosive growth, and really all of these tech stocks, the Big Seven, the Mag Seven, I'm not picking on any of them. They're really reminiscent of the Cisco days and the Intel days and even the GE days that dominated their eras. Nobody would ever think that they would ever go down or struggle. And then later they faced stiff competition nobody saw coming. The rapid rise of valuations often leads to extreme valuations, price per earnings share just out of whack. And usually people know it, but they just start saying like, this time is different, that kind of stuff, as you've probably thought of yourself. And that just makes companies very vulnerable to downturns if they fail to change and adapt to that. And look, here's a big one. Not all companies recover. You got BlackBerry never regaining its former glory. Cisco, we said. Others, GE, restructured and evolved, but not like where they were before. So these outcomes are never certain. No one can predict if companies like NVIDIA, et cetera, will grow forever, if they're going to suffer a fate like GE or BlackBerry. Nobody can predict the future. Even right now, like year to date, we're looking at NASDAQ down close to 15% as of March 9th. I don't know how the end of 25 is going to be. We could be having this conversation at the end of 2025 and saying the NASDAQ is at all-time high levels again, and so is the S&P. Or we might say, of course we saw that coming. It's just like 2000, and who didn't see the S&P dropping 40%? Here's the good news. You don't need to predict the future. You don't need to worry about the S&P or the NASDAQ or any individual stock, because we build diversified portfolios so that no stock can destroy what you've worked so hard to build over time. That's the key here. What is the purpose for your money? It's not to hit the lottery or to beat your neighbor or the S&P. The purpose of your money is to fully fund your retirement plan or whatever plan we've built for you. And that's the point. We don't need 20 and 30 and 50% returns. We need smooth returns, 6, 7, 8, 9% returns, not linear, but reducing that volatility over time is exactly how we're building your portfolio. So far this year, the international exposure is really paying off as it's up double digits while other areas struggle. I don't know how that's going to turn out. It doesn't matter. Let us worry for you. If you're nervous, give us a call. That's it for today. Let's pivot to my favorite part, compliance. Registered Representative, Financial Advisor, Park Avenue Securities, LLC, Pass OSJ 5280, Carroll Canyon Road, Suite 300, San Diego, California, 92121-619-684-6400. Securities products and advisory services offered through Pass, member FINRA, SIPC. Financial Representative, the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California. Insurance license number OD34103. This podcast is for informational purposes only, not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers that are firms are not affiliated with or endorsed by Past, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian and subsidiaries, agents, employees do not provide tax, legal, accounting advice. Consult your tax, legal, accounting professional regarding your individual situation. All investments can contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. References to specific securities, asset classes, financial markets are for illustrative purposes only. Do not constitute a solicitation, offer, recommendation, or purchase or sell a security. Past performance does not guarantee future results. Indices are unmanaged, and one cannot invest directly in an index. 7685853.1 expires March 2027.